All right, the Central Bank of Nigeria is wrapping up the month of September and the third quarter with the Purchasing Managers Index reading showing much better than the month of August. 55.3. Remember, 50.0 is the benchmark, is the mid-level. Any figure below 50 reading shows you are in the water. Any number above 50 shows that you are above water, or to put it what, you are in the money. Now, September this month finished on the manufacturing sector, 55.3. That's about 1.7% better than 53.6 reading in the month of August. That's what the Central Bank of Nigeria Purchasing Managers Index tried to throw this economic data into the mix before we wrap up the month, go for the Independence holiday on Monday, and everybody returns to work on Tuesday, the 3rd. But I'm here on Monday. Don't think I'm going on any holiday. Not anytime soon. But of course, let's get on with the debt market. The Buhari's administration seems to have found a way to start reducing the cost at which it's borrowing locally. This looks a bit of a lot of financial engineering, and everybody who is on the market, in the money, knows what is going on. I have an idea that the government has found a way to start reducing the cost of borrowing, but the government is still very big in the market, as anyone here will tell you. Obianiju Nsoforo is from Afrinverse, is one of the research analysts, is live here in the studios to take us through this debt market. Good morning.
Good morning, Boston.
This is, looks like something is happening, isn't it?
Yes, it is.
Yes, it's happening. How is this Buhari team from the DMO to the Ministry of Finance to the Central Bank? It looks like this is the coalition of those who are finding a way to reduce the cost of borrowing. How are they achieving this?
Well, definitely it's not news that the federal government is currently embarking on a borrowing spree in order to fund the 2017 budget deficit of about 2.4 trillion naira. I mean, looking at the breakdown, the government plans to borrow about 1.2 trillion naira domestically and about 1.1 trillion naira from external sources. As of 2017, we are yet to explore any opportunities for external sources. Early this year, we saw the federal government issue Euro bonds, but this was largely for the 2016 budget as well as the diaspora bonds. So they are opting for a cheaper source of deficit. As of 2016, our cost of servicing was about 66%. So what the intention is to free up more capital in order to pursue viable projects which can, in the medium term, yield economic benefits to the economy. So
if we hear what you're saying right now, time to spread it out on the table for everyone to see. What we're seeing right now in terms of the fresh $5.5 billion, which was reported by Bloomberg 2 days ago by the DMO, is for 2017.
It's for 2017.
Budget that started in July.
May,
okay, technically, May, June. Yes, I think about June when the budget was signed. So that is a fresh round. For 2017 calendar that started about 4 months ago. And then since July, the debt office, the DMO has been doing a rapid month-on-month FGN, Naira bond. And what was done this week was massive. 234 billion, almost 235 billion, when the government was looking for 135 billion. It was massively oversubscribed. Then we have the Sukuk bond, also subscribed, 105.878 billion naira. Now, why are investors interested in lending this massively to the government, even though the rates are beginning to trend lower?
Well, definitely, the federal government needs to fund the 2017 budget, and as doing so, they need to offer attractive rates to investors in order to lure them to give them their funds. So as such, you see rates in the domestic space as high as 16%, 17%, thereabouts. However, for the when you look at the external sector, we are looking at yields in for example, in the U.S., you see yields for 10-year bonds at 2.4% thereabout. The benchmark rate at U.S. is about 1% to 1.25%. It's probably the highest when you look at the major central banks across the world. So the federal government is trying to take advantage of this rather than offer the domestic, rather than source for funds from the domestic space at this high interest rates, they are actually opting for external sources of borrowing in order to lower the cost of servicing. So as such, investors have this perception that interest rates is going to sort of moderate in the medium term, and as such keen into longer dated instruments. So the demand is sort of outweighing the supply, and hence a moderation in the rates.
That was the question why investors are locking into the long end of the market rather than the short end.
Yeah. Yeah, it's definitely because there's this perception that rates in the medium to long term is actually going to reduce.
That's the central bank is likely going to do something.
Yeah, you see in the last 3 weeks, the CBN has stopped issuing longer dated OMO instruments.
That's the open market operation, treasury bill.
Yes. So they have stopped. So investors have sort of seen this, and if you look at the treasury bills market for the last 3 weeks or thereabouts, you've seen that investors' participation has largely been due to the 364-day instruments. As such, there's this perception that in the medium term, rates are actually going to moderate.
Either ways, the rates at which we're looking at are still in the double-digit region, isn't it?
Yeah, it's still quite high. That's why, as of now, the federal government is trying to alter the debt mix. If you look at our debt profile, about over 76% thereabout is largely skewed to domestic debt, while about 20%, 21% is largely skewed to external debt. And these external debt are more of bilateral and multilateral in nature, which we're given at a concessionary rate. So as such, we are yet to explore our capacity as regards to external debt. So that's why the federal government is currently embarking on that borrowing spree for the external sector.
The cost of debt is still high, but even with the cost, what is the yield on it when everything starts going down? Do you see any time soon when we could see coupon at 9%, for example?
As regards to the external bonds, we plan to...
No.
Okay,
locally.
for locally,
Domestic, yes.
Well, that's still a long shot. That's still a long shot. Our benchmark rate is currently at 14%. I mean, OMO yields are currently at 17% thereabouts. So it's unlikely that anytime soon we would see them get to as low as 9%.
So what would you folks be telling investors who's looking at, well, it's been a very sweet time. They've had 20%, they had 19%, they had 18%. Now we're gradually creeping to 17 and 16%, and rates on the streets is gradually narrowing to the MPR.
Yeah, well, definitely, investors for now, they have two ends of the market to play at, as opposed to last year where it was only the fixed income market that was relatively safe. As of now, the equities market has been doing well. You can see by PMI readings, companies' performances have actually improved. As such, investors can actually take advantage of stocks that have been beaten down for the last couple of months or thereabout and actually play in that sector, or continue even at 17% for short-term instruments, OMO and T-bills is still quite an attractive rate. So investors have the option of actually playing in the equities market or in the fixed income market.
I'm not sure if you agree, but almost everyone on the street thinks that the government is overborrowing.
Well, the question has to go back to why are they borrowing? I mean, we fell short of our target, our revenue target in 2016, about 18% short, and as such, the government has to embark on a borrowing spree in order to fund the 2016 and 2017 budget. So as of now, our debt to GDP ratio is quite low, so you cannot actually say that they've actually breached any gap or not. And if you look at our debt structure, it's majorly skewed towards domestic borrowing. In the event of any crisis thereabout, they can actually print up more money. Worst case scenario, to pay up this debt. Our foreign debt, we are yet to explore opportunities there. So for now, it's quite safe to say that the federal government is actually on the right course.
Still on track.
Yeah.
But as yields begin to go down, for those of you who have mutual funds, and you've locked in monies into these treasuries and bonds, hoping that the good days will remain good, Now it looks like the government is dragging you, fund managers, and PFAs, for example, insurance companies who are a little bit heavy, including banks, holding these bonds into what you call this cost-saving room, as it were. Do you think it will have any major impact on this mutual funds and other assets that are tied to these bonds and treasuries as the yield on them begin to lower? Well,
definitely. What these players in this end of the market are looking for are returns. So this is going to translate into a reduction in their returns. But thereabout, we need to look at the bigger picture. I mean, we are currently in. We need to get ourselves out of our current predicament, and as such, the federal government has set us on the right course in order to pursue an expansionary budget, in order to take us out of our current predicament. So, looking at the bigger picture, as such.
Yeah, but again, if I'm the one that has money there, I'm going to be a little bit worried because if I had planned for 20% for 2017, here we are in September, entering into October, and I see my rates coming to 16% or 17%. And when I thought that initially, I'm really, really way ahead of inflation at 60%. Now, this is where rates are. This is not going to, I'm going to look at the government again and say, hey, I'm not too sure I like this, the way this are going. But in view of this, do you think investors, portfolio investors and others will begin to reweigh their assets mix in terms of whether they should go a little bit more into stocks where there's a bit of a liquidity, even though bonds and treasuries is a lot more safer?
Well, it's most unlikely because for equities and fixed income, they have a threshold in which they can actually invest in the equities market. So as such, they're going to play as long as they don't breach that regulatory threshold or thereabouts. For the fixed income market, we've just seen about a 1% or 110% basis point decrease in yield. It's not that significant for it to sort of significantly impact portfolio returns. So thereabout, there's still opportunities in the fixed income market. We've seen, as of recent times, investors are actually keen into longer-term instruments, the 2037 bond instruments and thereabout. So there are still opportunities in both sides of the market for them to explore.
Maybe I just rebalance. Maybe I just rebalance my portfolio a little bit. But again, doing business with the government is still good business, or lending money to government.
It's still relatively safe than actually opting for equities or thereabout.
You guys in the debt market are the ones making a kill these days. You're the one having all the fun.
Well.
Just as everybody's getting out of a contraction, you folks are still smiling. That's very interesting. Thank you very much for coming.
Thank you.
We appreciate that. Uju, and see you at the other side in the new month of October from Afro Investor Research Analyst.